Hey everyone, welcome back to another episode of Punch Card Investing. We have a very special topic today on quantitative investing strategies as they relate to value investing. But before we get into that, be sure to smash that like button because that helps our channel out a lot to reach other people who might be interested in value investing and all the stuff that you're interested. That's probably why you're here in the first place. But also hit that subscribe button if you haven't already, so you don't miss any notifications when we go live every single week. Since this is a weekly podcast live stream, whatever you want to call it, where we just talk about all things value investing. Anyways, back to this topic of quantitative strategies. Think the magic formula, acquires multiple, and all these strategies that you may or may not have heard of by now. I'm going to have a little discussion about those and the merits behind them, whether they're worth it, whether any of us are using any of them. Since I know on our channels individually, we've talked about a lot of these strategies before. So does anyone want to kick it off with a particular strategy when it comes to this sort of quantitative approach to value investing?
Guys, first off, is anyone using the strategy that they're going to be talking about?
I was planning on talking about Magic Formula, and I know Brad and I are, so I can kind of talk about that and some of what he does with it too. So Magic Formula is what I use in a little experimental portfolio.
Mm-hmm. Yeah, I'm going to talk a little bit about the acquirers multiple. I don't use that as a strategy at the moment, but sometimes I do. That's probably about the only screen that I ever use would be the acquirers multiple. Maybe a little bit of Magic Formula actually as well. So I can touch on that. But maybe I should go after the Magic Formula, I think.
Yeah, definitely. That would make sense. Frank, Ron, what about you guys? Any sort of incorporation?
Yeah, I use, so I'm going to be talking about high short interest, and I've used that once or twice.
I'm doing net.
Yeah.
I think we lagged there for a second.
And I'm doing net invest.
Yeah, it's Frank. Frank's lagging. But I think Frank's trying to say that
phrasing up.
Yeah, I think Frank's trying to say that he uses nets.
Nets.
Frank, we'll come back to you once you reconnect a little bit.
Can you hear me now? Am I lagging out still?
Yeah, a little bit. All right, you seem to be moving again. You're animate again. Oh, there he goes.
Yeah, he's gone.
We've lost him. Anyways, I guess going chronologically, I suppose I'll talk about Magic Formula first, and we'll do acquirers multiple for you, Tom, since that's kind of the follow-up to it. Magic Formula, we've talked a little bit about it on the stream before, and also outside the stream, of course. It was the brainchild, I suppose, of Joel Greenblatt, a very famous value investor who has had quite the track record in his own right. But he discovered this sort of anomaly with certain value stocks in that if you looked at two very specific factors, return on invested capital and earnings yield, so essentially quality and cheapness, if you took those two together and you ranked all stocks based on those two rankings and then just added whichever the highest rankings were for those particular stocks, if you just added them together and ranked those stocks accordingly, the highest ranked stocks, if you had a pool of those, would outperform the market by quite a bit. That's the study he did in the little book that beats the market. And it's a very simple approach to it. And there is an updated screen that goes out all the time. I think it's updated daily. That's magicformulainvesting.com. You can open up a free account and take a look at it. It's definitely a great source for investment ideas, if nothing else. And I think that'll be something we probably all touch on. All these strategies can be great ways to find ideas, whether you follow them as a doctrine or not. That's actually how I first learned about the Magic Formula strategy and being something viable. I think Brad did a video a long time ago about how he follows it. And I had heard about the strategy before, but I never really looked into it. But Turtle Beach came up on it. They're a gaming headphone and gaming accessory company, came up on it. I did some more digging into it and it looked really attractive given what I was going for. And I added it to my portfolio without having followed the Magic Formula on my own. And so that was like, okay, maybe there's something to this. It found a company that I liked. I wonder what the rest of the list looks like. And then I actually read the book after having been more thoroughly introduced to it. And I decided to start my own little experimental portfolio with it that I'm updating monthly. So that's a long-winded way of explaining the Magic Formula portfolio. Have you guys considered using it at all? Do you guys follow the screener? And I'd definitely love to get your thoughts on the strategy.
Yeah, I follow the screener a little bit. I'd be really interested in your thoughts on or experiences on actually practically applying the strategy, because I know it's one thing to like read a book and say, these are the cheapest and most high quality or best combination of those two factors, and you should just buy a basket of these. But how have you been sort of working through that practically? Like, how often are you rebalancing or buying and selling? Have you had any like tax considerations in terms of what type of account you'd run that sort of strategy in, or any learnings like that?
Yeah. So I have I'm probably doing what would be considered a modified approach, though in my mind it feels more like the pure approach to the magic formula strategy. And to explain that, in the book, Greenblatt advocates for buying over the course of a year a couple stocks every month or so from the magic formula screener, not selling them for a little while, but over the course of the year, you build up about 20 to 30 holdings from the list. And that's companies with over $50 million in market cap with that rank high on the screener. So you'd build your portfolio over a year, and then at the end of a year, and then from there, you would keep cycling out holdings after you've held them all for a year. And if they're still on the list, you hold them. If they're not, then you sell them. So the idea is to have a hold time of 1 year for each holding. And the reasoning behind that was capital gains taxes, in that once you hold something for a year, you have long-term capital gains taxes, which are lower than income taxes in most cases, at least for kind of higher earners or who you might consider the investment class. It's typically a much lower rate than your marginal income tax rate, at least in the US. So that was kind of the idea behind it. I modified that in my own approach, since I'm doing mine within a tax advantage IRA. So here in the US, if you put something in a traditional IRA, or really any IRA, you don't have to worry about short-term capital gains taxes, or any capital gains taxes actually, while you're making trades or whatever in it. So I thought I would rebalance the holdings every single month based on what the new list is. So if anything falls off the list, I get rid of it. If anything is added to the list, I add it. So I constantly maintain. I was doing 50 holdings, but now I'm doing 30 holdings, the top 30 from the screener, all within that IRA to get rid of that tax consideration. And there goes Frank again. And we'll see. I want to see how that does. And I'm trying to collect about a year's worth of data to see would that have created a gross under or over performance based on the actual magic formula strategy. I don't know if I'll keep doing that. Right now, I'm down like 7% or a little bit less than that over the last 5 or 6 months now. So not a great start, but then again, it's only 6 months and this is a longer term strategy. So I'll be curious to see what happens there. But that's what I'm doing with it. What are your thoughts on that? Because I think Toby Carlisle would say something like you should hold everything for the long term if you got it at a relatively cheap price, and then ride those outsized winners as long as possible. Whereas with my strategy, I might be cutting those winners short if I'm rebalancing too often.
Yeah, I think Toby or even Joel Greenblatt would probably say, particularly Toby, I think would say, let's just back test all those options and see what works, rather than kind of trying to make a bit of a guess at letting winners run and that sort of thing. And I've read the little book that beats the market as well, and which is the Magic Formula book. I'm not sure if we mentioned that already or not, but it seemed like the primary motivation for holding for a year was purely tax. So I'm guessing a bit, but I don't know. I'd be interested to get like a Joel Greenblatt opinion on whether he would rebalance more frequently.
I would, because my thinking was, because that was the reason. If you remove that reason, then there's no reason to not rebalance. That was my thinking, but perhaps it's an accident that maybe there would be big outperformance just by holding, because you ride your one outsized winner that carries the whole portfolio or something like that. And that's all that. I think what I'm really getting at is the magic formula just carried by a couple holdings every year, or is it really carried by like the whole portfolio or most of the holdings in the portfolio? I have a feeling it's probably the former, that it's just a couple holdings that actually carry it. And that's probably the case with many value investing strategies. That is value investing after all. You're probably going to have underperformance for a while, but all you need is the one or two outsized performances that do really well. And then that makes a career. So that's my thinking.
Mm-hmm. Yeah, it's interesting to also see how not just the magic formula, but a lot of these strategies tend to randomly get concentrated in different years in certain industries. Like I think at the moment it's quite concentrated in pharma stocks, right?
Yeah, it's like 30% pharma right now. So
yeah,
that's one thing I'd also consider adjusting is actually just removing pharma. Or once I get this year of data, I kind of want to do some back testing to see if I had not bought any pharma over the year, would I have done much better or not? That'll be interesting to see too.
Yeah,
and the reason the reason that's a concern is because of the quality metric, in that a pharma stock might have an artificially high return on invested capital. You can really say this about any business, but it seems like pharma's particularly susceptible to it. If it had a really great year last year, it might make the screener for Magic Formula saying, hey, look, this high quality business that made huge returns on its capital because it had like a drug release or something like that. But there's no guarantee that that carries over the next few years and isn't really an indication of true business quality for the long term, at least. That'd be my inclination there too.
Yeah, and it's probably tough to say. Like I'd imagine the same sort of thing happened with the acquirers multiple a couple of years back. It was very concentrated in US financial businesses. And it's probably hard to say. Like I'd imagine over like a 30-year back test, for example, probably sometimes being concentrated in those little pockets of the stock market would be a really positive thing. And I'd imagine sometimes it's a really negative thing. It's kind of hard to, I'd say, gather from 1 year of data whether it's a good choice or not to like back those things out. I don't know.
And I wonder if pharma's always been kind of a big thing, at least for Magic Formula. Is it always like this, or is it just now because they happen to have lower PEs or lower earnings yields compared to other sectors? Like, you know, we've all heard about tech having ludicrous valuations compared to their actual earnings. And that's happening in a lot of sectors. So maybe it has something to do with that. I don't know if pharma's always been kind of like this, because if so, then what would have happened if you removed pharma from the initial back test that Greenblatt did that made the Magic Formula look really, really good as it was? Could it have been even better if you removed pharma? I wonder.
Don't know.
There are certain sectors that he does not include, right, in the Magic Formula portfolio.
I'm not confident. He recommends just nothing below 50 million market cap. So no like super micro caps. And
I think banks are not included. Is it banks? I remember he mentioned it in the book, but
you might. I think you're actually right about that. I'd have to check the book again because it's been a while since I read it. And plus, it is all U.S. focused, so it's all U.S. listings. So you're losing out on all international stocks. I'm sure you could apply the same concepts internationally, but it would just take so much more research and all the different regulatory requirements that give you different sets of information.
Yeah, there is actually a Magic Formula ASX website. I think it's called I'm just bringing it up. It's called shareranker.com, which I think does all of the ASX Magic Formula application.
Oh, nice.
And Australia is a funny stock market in general because it's very like resource focused. So there's like a gazillion different, and that's the technical term, a gazillion different mining stocks and stuff in Australia. So it's all just mining, and that's a really good example of where you can have very volatile earnings and return on invested capital can look amazing in a single year. So that would be a really interesting one to try and apply the Magic Formula to.
That's another thing about the Magic Formula is that it's relative. So like if everything is expensive, it's only looking at the cheapest, best relative to everything else. So if you're comparing something to something already poorly priced, you might not be getting the best deal, but you would think that with thousands of stocks, you'd still get a decent sample out of it. But that is something to consider, especially with like a smaller market like the ASX or any other listing you want to look at.
Yeah.
I think Brad covered it in his recent video that you can use Sticker to use the Magic Formula across the world. So have any of you looked into that? I think Frank has been using Ticker recently. So have you seen that?
Yeah, I've seen Brad's video and I've used it a little bit. You can't directly do it the exact same way. I think you have to make a few adjustments. I'm not sure exactly what he did. I'll have to rewatch Brad's video. But he just uses the EV to EBIT multiple instead, which is just the inverse of operating earnings yield. So yeah, overall, you can get a fairly good outlook of the companies around the world that are trading within that framework.
Ticker is a nice tool, I must say.
Mm-hmm. We should get them to sponsor us.
Yeah. Once they start making money,
Yeah.
everything's free right now.
They
Same
just
with
still
Joel
need
and
to-
Toby. They should be sponsoring this episode.
Yeah, we should. Well, I guess we could. Maybe I'll put an Amazon link to their books and we can get a little commission that way or something.
There you go.
Speaking of Toby, Tom, why don't we go over the
Hmm.
acquirers multiple, which is kind of a response to Magic Formula.
Oh, I'm glad you bring it up.
Oh,
Jack.
fantastic! I just read the PDF of Magic Formula. I don't have a physical copy.
Yeah, I've been refreshing my memory on some of the actual returns and kind of what Toby was trying to do this morning. But yeah, I guess Toby Carlisle basically read the Magic Formula, and the first thing that sort of occurred to him was Joel Greenblatt is screening basically on two metrics. So he's looking at how cheap the business is using an earnings yield, and then he's got return on capital for a proxy for business quality. And the first thing that sort of occurred to Toby was like, what happens if you throw one of those criteria out the window and just focus either purely on return on capital or purely on just buying the cheapest companies, regardless of their quality? So that's basically what the acquirers multiple is about, is going through that back test. So this includes basically running a few different strategies. So he compares the S&P 500 to the Magic Formula, and interestingly, in his backtest, he actually got slightly different return numbers than what Joel Greenblatt got, but in the same sort of ballpark for the Magic Formula. He then looks at the acquirers multiple, which is EV/EBIT, which is fairly comparable to just the earnings yield that Joel Greenblatt is using. So just sort of cheapness. And then he actually also uses another one, which he calls Pure Charlie, which is sort of influenced by Charlie Munger, and that sort of does the opposite to the acquirers multiple. So instead of focusing on valuation at all, he just buys the best businesses on return on invested capital. And some of the returns are pretty crazy. So I guess Toby probably wouldn't have released this book if this wasn't the case, but yeah, but the acquirers multiple had the best returns. So in the like appendices of this, and all this stuff's available online as well, there's various different back tests which look from 1973 to 2017 was the period of time that was looked at. And yeah, various different back tests with different sort of market cap thresholds as well. So he looked across a few different.
Could you give us some of the comparisons just as like a reference?
Yeah, sure. So if I go $1 billion or greater in market cap from 1973 to 2017, S&P 500 did 10.2% per year, and this is total return. So this includes capital gains, dividends, everything. So S&P did 10.2% per year. Pure Charlie, which is just the return on capital metric, did 13.7% per year. Magic Formula did 16.2% per year, and acquirers multiple did 17.9% per year.
So slightly better when you removed the return on invested capital metric, which in its own right did better than the S&P, which is also interesting.
That's what I found really interesting as well. The Pure Charlie strategy actually also beat the S&P 500. So, you know, obviously, like it is only 1 or 2% different in that example, but that compounded over 40 years makes a very significant difference in the end number.
Even over 5 to 10, that can start to add up quite a bit.
Yeah, so it is really significant. I think one of the things you will find with the acquirers multiple, though, is you'll get some much uglier companies because you're not caring about quality. And you know, Toby's been very open in some of his in some of the interviews and stuff he's done, and saying that, you know, you can't just pick like one company or something out of an acquirers multiple screen. You've got to buy a basket, because some of these go to zero. Like some of them are terrible companies that go bankrupt, but if you buy a basket of them over a long period of time, you do reasonably well, and or very well, I should say, according to these back tests. And the other thing is, I think the strategy seems to be more volatile than something like the Magic Formula. So you can go through sort of more wild swings relative to the market, but again, over a extended period of time, it seems to perform well.
I'd assume the volatility decreases if you increase the market cap, or are you sure?
I'm not sure. I think that if you give me a second, that might actually be in here. Just using like beta as the...
Because I think Greenblatt talked about that in the little book that beats the market as well. If you want less volatility, then just bump up the minimum market cap, that'll probably do that for you. But you're also going to limit your returns. It's more of kind of a risk reward thing in the layman understanding of risk as being volatility.
Yeah. Yeah, hang on. The numbers vary a bit here between the market cap screens or back tests that were done, but interestingly, Pure Charlie is actually the lowest volatility here. So yeah, I know most value guys aren't going to care that much about beta, which is just basically relative movement against the S&P 500. So
if anything, it helps.
Yeah, exactly. Yeah, you get more wild swings relative to intrinsic
more
value,
buying
right?
opportunities if you're holding for the long term, of course.
Yeah. So a beta of 1 would be equivalent to the normal volatility of the S&P 500. So if you have a number greater than 1, you're going to be more volatile, academically speaking, right? And if you have a beta less than 1, you're going to be less volatile. So all of them are more than 1. So Pure Charlie, Acquirers Multiple, Magic Formula all had a beta higher than 1. Pure Charlie was actually the least volatile, so that came in at 1.02. And this is actually the reverse of what I thought it might say, but Acquirers Multiple was 1.1, and then Magic Formula is 1.12. So Magic Formula actually looks slightly more volatile, which is kind of surprising, actually, to tell you the truth. But again, it'll vary depending on the samples that are used and market caps and so on. But yeah, interesting strategy to just kind of throw business quality out the window and see what buying everything in the
it's
in the
totally
discount.
It's very much a
bargain.
see what sticks approach, which I guess is really what it's kind of like regular old index investing. You know, you're buying a lot of bad companies, but you're also trying to get the few good ones that carry. Like even with the S&P 500, like it's 500 something companies are around there, and a huge portion of the market cap is in like the top 10 holdings. So like you're betting on a few holdings carrying a lot of the weight, maybe not all the weight, but that's all you really need to carry your index. And in this case, it's just a more focused index on cheapness.
Yeah, and in that book, Toby talks a lot about the concept of mean reversion. So he talks about things like return on invested capital. You know, businesses that typically have very high return on invested capital over time as a group tend to revert back to a market average return on invested capital. And actually the opposite happens as well. So companies with low return on invested capital tend to revert kind of upwards to the mean as well. And that was kind of like one of the key driving forces he sort of saw for the reason that things like the Acquirers Multiple did quite well. If you can just buy all the companies that have really bad expectations of business results kind of built into the price, you tend to do okay because they're priced as if, you know, everything's going to go wrong. And oftentimes that doesn't happen. So
sounds kind of like a GameStop situation. Dare I say it?
What a segue. What a segue.
Here's your final summary on that. Buy low for a lot, sell high for a few. I guess that's kind of the ultimate goal. Maybe not the goal, but what ends up often happening when it works. But how about it, Ron?
Yeah, but like when we're looking at these, the cost, how much you're paying for the business, I like the Acquirers Multiple because of that. Like you're not looking at business quality, but if the asset is cheap enough and the price is right, it makes sense to get in, you know.
That seems like the starting point just for any evaluation or any evaluation of any investment. You just want to see like, all right, how much cash is it throwing off relative to price? Like that should be like step number one. And then you go into the other stuff to see. And that's again, like for anything, stocks, real estate, whatever asset it is, unless you're speculating, of course.
Yeah. And sorry, I might just say one more thing before we jump to some short interest examples. But one of the other, so the fact that the Acquirers Multiple is EV/EBIT and using enterprise value, although it will buy some pretty average companies, the fact that it uses enterprise value means that it will reward companies that have a lot of cash and less debt. So you probably are getting slightly higher quality companies, I would think, than if you were to just use a simple market cap as sort of the price metric. Yeah.
How about it, Karan? Short interest?
Sure. So short interest is kind of the place where like quantitative meets behavioral finance. And the reason that I talk about behavioral finance with high short interest is because we know that there's a lot of irrationality in the market. And when you're shorting a stock, we all know that the odds are not really in your favor, right? The max you can make is a double if the company goes bankrupt, and the highest loss that you could have is unlimited, because theoretically there's no, upside to the how high a stock price can go. So what you're kind of using is the rationality of market participants, but that's determined by quantitative factors. And when looking at high short interest, the thing to look for is the rate of change of high short interest. So a company can be like not very shorted, but then suddenly if the short interest goes up by like 3 times, 4 times, you have to be wondering, why is that company being shorted? Why is it being targeted by so many of the market participants? Is there some bad news? Is there some fundamental, misalignment? And that's kind of why I like to use short interest. I haven't really seen any other investor like get into short interest specifically. I mean, not I'm talking about earlier. Like now we know Reddit and everyone's into it, and that's one of the reasons why I think that this strategy might not work as well anymore, because a lot of people are using it.
It's not a secret.
It's not at all a secret anymore. Yeah, but at some point it's probably going to get boring again, and people are going to forget about it. And I think that's when we'll see like short interest be more meaningful. Yeah, I think we're trying to use this. Sorry, yeah.
One thing that's weird, I just want to with like the short squeeze phenomenons we've seen, it's like a feedback loop at some point, in that if you trigger a short squeeze, it might throw the price up really, really high, which will then attract potentially more people in to short it because, hey, now it's super high. And if they don't like the company already, which might keep the short interest pretty high. But then like, what is the point where like you can't add any more money to it? And that's like the new peak price, to where then new shorts will drive it all the way back down to where it might have been at the start. It feels almost like a net zero game, depending on what happens, of course, if the company doesn't raise money out of it and help themselves out, like we've seen with AMC and GameStop.
It's not always like AMC and GameStop. So
right, those are anomalies.
Yeah, those are absolute anomalies. But so one example that I had was Nordstrom. So back in like late September, early October, Nordstrom's stock had really fallen because they had pushed their anniversary sale, which is like their version of Prime Day. And the stock was crushed because of earnings. And what got me interested in it was that the short interest went from like around 10 to 15% all the way up to 40%. So that you saw like a 3x increase in the short interest. And clearly people were really, pessimistic about this company. But fundamentally, what had happened was that the management had decided to push their huge anniversary sale to the next quarter. And it was obvious to me that, the same way that the market is highly pessimistic about this, they're going to be very optimistic about this in the next quarter, right? Because of the short-term focus. And that's pretty much exactly how it worked out. Like, I think I started buying it when it was around $11, $12. And within like 2 months, it was back above 30. So it was like a 2x, 2.5x in like 3 months. It's a fantastic return. And you get that because you're looking at more at the irrationality of market participants, and couple that with like the fundamentals of the business, and you're able to get those outsized returns.
So you're looking at the swing to test sentiment, not even just you're not going into it with like, all right, I want a short squeeze. You're going into it with like, okay, this swung really hard one way, probably too hard. And if it can swing hard one way, it could swing hard the other. That's kind of what you're getting at.
Exactly. But the key difference is that, I had a price in mind because I could figure out what I think is the value of the business.
Right.
So at around $30, $35, I decided to sell out. And the short squeeze kept happening, right? It went all the way up to 45. And other people who kind of just copied what I was doing, kind of held on and said, I have no idea what I'm doing anymore because the stock has gone all the way up to 45 and I sold out at like 30. I said, it's perfectly fine. I'm happy with a 2x in 3 months. And if you guys want to hold on, it's perfectly fine. If you look over the stock is today, it's back down to around $30 per share. So like a 5 billion or so market cap, because that's roughly what the fair market value of the business is. I mean, for now. So, kind of goes to show you that short-term voting machine, long-term, if
Have we lost
Brian
Karan?
just freeze. Yeah. That was good too. Like that is a good illustration. What is going on with the internet today, guys?
Don't know.
Oh well.
That does go to show like how short-term focused people are to back out of a company just because they push their big sale event out a little bit, right? That actually that actually reminds me quite a lot of See's candies. Like, I'm not sure if you've ever heard Buffett talk about how See's basically loses money 11 months of the year, and then they make a killing around Christmas.
It's a lot of retail companies. Yeah.
Yeah, I couldn't imagine like what that would be like as a public company when you're reporting quarterly earnings.
You do some
like that
magic.
Yeah, that's the type. Well, that's the type of thing where like companies get pushed into doing irrational stuff, like changing their business model from a really good business with some unusual timings throughout the year to diversifying, as Lynch might call it, right? So
right.
Yeah.
That is a good example. Just retail in general. Because it's not as though it's like we say predictable cash flow model, but it's kind of like it's not. That doesn't mean like money's coming in every single week at an equal pace. It comes and goes in waves, depending on what's going on. Especially with retail, that's often very holiday sale focused. For that one big push once a year.
Yeah, I mean, you still see it with even massive businesses like Apple will have a really good Christmas quarter.
Yeah.
Alibaba, which we've been looking at recently, has Singles Day, which like you see annual sale charts and then you see this random spike one day every year. Like, what's going on here?
Yeah, like Black Friday. End of the year stuff. Yeah, it's always crazy, at least in the US. And whatever big sale goes on for any company is always going to be a big deal. I wonder what Prime Day numbers looks like. I've never really looked too deep into that. Granted, I'm not really sure how much is out there as to how much more sells on Prime Day versus else for the band. Anyways, Frank, let's get into what you got for us.
All right, so my internet over here in Australia is not doing too well today. So if I lag out
now,
if I lag out, just cut me off and take over. I'm looking at net-nets today. So probably the oldest quantitative strategy that's managed to outperform for about 85 years or so now, since Benjamin Graham first come up with the strategy. Of course, Buffett in his early days took a similar strategy, applying some of this net-net approach to investing. So a net-net essentially is buying a company below its net current asset value, which you just get by taking their current assets minus their total liabilities and preferred stock. But just to keep it simple, it's current assets minus total liabilities. And you want the price or the market cap of that company to be lower than its net current asset value. The idea of this is for essentially downside protection, as well as a bit of mean reversion. But essentially, if the company went into liquidation, it would actually benefit the shareholders because the overall value of the company or those assets is worth more than the actual market cap. So it would be a good thing for shareholders that are buying into a net-net. And this has been proven over time for a very long time. It's also called cigar butt investing, which essentially you're entering some really terrible companies. There's no quality aspect to this investment strategy, which is, of course, partly why Warren Buffett shifted away from doing stuff like this, moving more towards the Munger or Fisher approach to investing. So just for some numbers, there's a lot of studies over time that have been done on net-nets and all these variations of pretty much the same strategy. So Greenblatt has done a couple strategies on this as well, which partly I think he mentions inspired him to look for something like, which eventually became the magic formula. So he looked at a period over about 10 years in the 1970s through to 1980, where net-nets returned 40% per year. So I don't have the number for the market over that time period, but 40%, I think it's safe to say it's a great outperformance.
Market is pretty sideways during that
Not
time,
bad.
so really
And,
anything positive is already a good start.
Yeah, typically these type of quantitative value approaches will perform best in a either bear or sideways market or something anyway, which is probably why something like Magic Formula hasn't worked too well over the past 5 to 10 years, because we're in such a bull market. Another study was actually by Tobias Carlyle. So, of course, he did Tom's approach, that requires multiple. He looked at 75 years of the strategy and had a 22% return. He went specifically into a period from 1983 to 2008, which I think is about around the time periods he looked for acquires multiple. Is that right, Tom? That sound about right?
Sorry, run that time period by me again.
He said 1983 to 2008.
Didn't Acquirers Multiple go to 17?
73 to 20. 1973 to 2017 was
Yeah,
Acquirers
so real
Multiple.
long.
Okay, so he extended it by about 5 to 10 years each side. Over that time period, though, it was 22.4%, which I believe is higher than the around 17% of Acquirers Multiple. Another study is by Joseph Goebel, who found a 32% return over a 40-year period from 1970 to 2010, roughly. And there's lots of other studies that go into this. It is a popular approach in academic research. So often they'll compare the price to net current asset value to whatever quantitative approach they're looking at. And even Tweedy Brown has done some studies of, I think it's studies called What Works in the Market or something along those lines. And again, net investing came up as the best performing strategy. So it's really a time-proven strategy. And in the last 10 years or so, a lot of people have kind of moved away from the strategy and thinks it doesn't work anymore. But I think it falls into the same reasons as something like Magic Formula or Acquirers Multiple, that really just these strategies don't work as well in a huge bull market, which we've been in for some time now.
To that, this was an interesting point with the cigar butt style strategy. Karthik says, my assumption about net cigar butt investing is that if it doesn't work, then it needs he says that it doesn't work because it needs like an activist investor role for forcing company for liquidation. If it doesn't just kind of happen on its own, like it needs some sort of extra catalyst there to push it along.
That's what Buffett kind of did earlier on, is he was looking at these type of companies and he was essentially the activist. Not to the typical sense that we see with some other activist investors today, but he was very active as a shareholder. And of course, if you're looking into nets, if you can come across something with a board member or management team that are even suggesting liquidating the company, or perhaps a huge buyback program or some other capital allocation decision, like a special dividend or something that's going to benefit shareholders, that would be a huge added bonus to buying into a cigar butt. You don't necessarily need it. No, the approach says over time, if you buy a basket of these stocks, they're likely to mean revert back to about liquidation value. So Benjamin Graham said to buy 33% below the net current asset value, and essentially you're getting a 33% return with that mean reversion back to liquidation value or net current asset value.
And that's if the company just stagnates and doesn't do anything besides the mean reversion.
Yeah, so if you look at some of these companies, and I've backtracked a few over time, so I come across the ones that were net, say 10 years ago. Typically, earnings don't do much. They sometimes they even decline, but the returns from the company still seem to be great because it's just something that happens to companies that are this cheap. The mean reversion just manages to happen. And not all, of course, you're going to have some terrible returns from some companies, but the ones that do well usually do really well. So if you had 10, you might be carried by about 2 that maybe give you a quick 100% return or something like that.
SC358 brings up a good point, though. Just to watch out for with that strategy is that you have to look at what the assets actually are. If they're immovable, He says, look at assets to ensure they actually have value and aren't essentially worthless. I think what he's really getting at is liquidity. So high replacement costs, but equipment can't be moved economically or it's out of date or something like that. That's not really that valuable in a liquidation. It might be valuable on the balance sheet, but you can't really do much with a specific piece of machinery that only works for this outdated company or something like that.
So
just
that
one to
there is
look out for.
approaches to that kind of cater for that. That's a common critique of the net strategy and just net current asset value in general. Some people use a thing called net working capital rather than net current assets, which is you keep all the cash and short-term investments as they are easy to liquidate. They're essentially the short-term investments are also cash. And then instead of taking all of your inventory, you take only 50% of it. And for something like accounts receivable, you take about 75% of that. And you still minus out all the total liabilities of the company. And then again, you're trying to get that discount with the price as well. So it's just a more conservative approach to make sure those assets are really worth something. And in the case of liquidation, can actually be called upon.
And I think it's probably less important to get into that sort of detail if you're buying a basket. Like if you're Buffett going in to be an activist at Berkshire Hathaway, it's clearly going to be quite important to understand what the assets are. But if you're buying a basket, probably not. And you're already using current assets, which can be turned into cash within a year, right? You're not considering any other assets, so it's already a very conservative approach. And if you're buying at a discount to that, then like we're getting pretty cheap at this point.
It's about conservative. It's about as conservative as you can get. It's ultimate downside protection, really. Worst case, you get a flat return is about, or a very minimal loss on your bet, and it kind of goes nowhere. But the upside is huge, so it's an asymmetric bet, and it really has worked for a very long time now.
It's the original buy $1 for 50 cents sort of approach, and no guarantee that dollar becomes $2, but it's still $1 when you first buy it. That's the idea. And it's definitely, it seems like a really good place to start researching if you're maybe looking for a longer term compounder or something like that. If you can get a really cheap one, at least your downside's protected, like you're getting at. And you should get some decent upside if you get a decent margin of safety compared to the actual value.
If you can find a compounder at that price, please send it my way.
Yeah, right. It's super rare, but if you get one, like, or even something that's close to that.
I think Monish says about that Turkish company. I forget which one, but I think he argues that he paid 4 cents on the dollar or something like that. So, assuming he's right on that being a compounder, that would be one example of it happening.
We've seen this net strategy struggle in Japan, right? I mean, there's a lot of companies with a lot of cash, but
I think
they don't use it. Yeah.
The main reason, for in Japan is that exact reason. They went through that huge inflationary period, and the companies over there typically just hoard cash. So these companies appear cheap because there's all this cash there, but there's no great capital allocation decisions happening around that cash. So it kind of just sits there. But the numbers do show that you do want to hold some of these Japanese companies because every now and then you do get a great capital allocator come in over there, maybe an activist shareholder or something like that. So I wouldn't exclude Japanese stocks from a net approach. If you limit to yourself to outside of Japan, you really won't come across too many opportunities at all. They are very rare. They're hard to screen for. And you just, in the US, for example, there'd only be a handful that actually are nets, and most of them are over-the-counter markets. So,
that actually answers my exact question. I was going to ask how many of these things actually exist these days, because I obviously I wasn't alive in the 70s and 80s, let alone invest in, but by all accounts, there were activists run around everywhere in those days and like liquidating companies. But, the only one I could really think of that does anything close to that these days is someone like Carl Icahn, but there's not exactly like 50 Carl Icahns running around still doing this stuff. So did they sort of all just get bid up very quickly in the States and in sort of more developed markets and just don't exist? Or
I think just currently the US market is just an expensive market in general. I think it's just hard for anything to get that cheap in this market, but I don't have a great answer for it other than the fact the market's expensive.
rates, bro.
And a lot of it's being propped up with debt, so it's not as though you don't have as much of the Japanese situation where they have a lot of debt too, but it's so much cash that's just sitting there. In this case, it's kind of debt that's swimming around, so it's not like you're getting as positive of a current asset value in many cases. That's a super generalized statement. You're going to find counters to that, but maybe that's why, because it's so debt driven.
And the last thing I'll kind of add on there is you can go one step further and look for something selling below net cash, which of course is just cash minus the total liabilities, and you're looking for a market cap below that. Those are extremely rare, and most of those do kind of come up in Japan, but really you have no downside in that scenario unless there is some absolutely garbage capital allocation decision that goes on there that really burns that cash. You do have to be careful with cash burn in these companies. You do want to look for quality and liquid assets where you can. Ideally, you want some kind of decision to buy back shares, and a dividend would be a nice bonus too in these scenarios.
Right on.
I feel like even with nets, one more thing to consider is the opportunity cost, because you're waiting for that upside to come, and
that's all value investing, right?
It's a very volatile strategy.
Very true. Very true.
Value investing, opportunity cost is like the huge risk. If you think you're getting a good deal, it could take a long time for that deal to actually show that it is actually a good deal. So that's just one of the challenges in general.
It's all investing, really, isn't it?
Yeah, I guess all investing in general. I think Tom, you'd be one to argue that really inherently all investing is value investing, and that you think you're getting something at a good price. Now, how you make that valuation is totally what differs wildly. But ultimately, like, you're not going to buy something if you know it, like, this isn't worth it, so I'm going to buy it. Like, no one does that. So it's kind of a value investing lens for everyone.
Yeah, I mean, I won't spoil one of your upcoming videos, but a recent transaction you had was 100% like an opportunity cost thing, right? You're like, where's the best place to put some money?
That's right. I just closed on my real estate deal today. So it'll be my new primary residence. So I was running around today, doing that. That will turn into a rental a year from now when I move out. Or I have to live in it for a year, and then sometime after that, I will be moving out. I obviously have to find another deal. I'm not going to force anything like that, but that is the plan there. So yeah, and that's in Chicago. We're less than a mile away from where I'm currently living, and I will definitely do a breakdown on that very soon. Now that I actually have it, I got the keys right here on my desk. There they are.
Nice.
So fantastic. It was a good day. Very busy. Shall we dive into some questions?
Let's do it.
Let's go.
Brad is on vacation. He's taking care of himself. That's something we should all take note of. He'll be back soon, though. Actually, what I meant to say is he's no longer with us. We kicked him off of punch card investing.
Well, I mean, he hasn't been replying to messages or anything, so I don't know where he's going.
He's been off the grid. But he warned us, so he'll be back. Don't you guys worry. Let me go back.
I think he's gone to Cape Cod. I asked him to go catch like a giant bluefin tuna for me and enjoy some sashimi. Email it to him.
Let's see. I guess this question could go to others as well. Well, I guess I'm the only American here. If you invest in another country where there is no capital gains tax or tax on dividends, would the U.S. still tax you on those overseas gains? I mean, everyone's tax situation is different, so I can't give like blanket advice of any sort. Though all I know is the U.S. taxes you on your income pretty much wherever it's made. It's just kind of a question of rate and whether there's credits or anything that apply to it. So I think it would totally depend on what country it is, what kind of company it is, and all that stuff. Taxes are complicated. Talk with a professional. That's all I could say.
Very generally, though, yes. Most people are taxed other than Kran.
Yeah. Sometimes nothing happens for years, and then years happen in weeks. That's value investing. Well said.
Is that an investing or life lesson? Yeah, I don't know.
That's a good quote to use elsewhere. I like that.
Mm.
But,
Sounds like software development, actually.
kind of. Jesse says, "Did you guys know that Carlyle's Acquirers Fund is underperforming the S&P as of his last annual report?" I'll toss this one to you, Tom, because I know you've done a lot of content about this sort of idea of underperformance, depending on what you're looking at.
Yeah, Toby's had a very rough decade, not just a last year. I think Toby's going to be the last standing value investor if it just stops working. Yeah, it's had a very rough year or a very rough decade. I mean, he actually had a podcast with a guy called Cliff Astis, who I think is from a firm called AQR, and I'm pretty sure is a billionaire, a very successful investor. And they do a lot of quantitative research, and Cliff Astis was trying to figure out like why has quote unquote value been underperforming, and for I forget the exact year, but it might have been like 2019. There were pretty genuine reasons why that sort of basket of the cheaper stocks didn't perform that well. Like their earnings just went nowhere relative to all the rest of the stocks in the investable universe. But since then, that really hasn't explained the underperformance. Like most of the underperformance has come from this really widening gap between the cheaper stocks in the market on some sort of price metric and the most expensive stocks in the market on that sort of price metric. And that gap is basically as wide as it's ever been. It got close to as wide as it is now in the .com bubble. And outside of that, it's now as wide as it's ever been. So Toby's had this sort of theory going for a little while that I guess he's obviously invested in this thing, but you know, it could be a good time for value, quote unquote, value to start working again. Because I mean, I'm even seeing that anecdotally. Like there are pockets of the market that are just obscenely expensive that I would not touch with a 10-foot pole. And there's actually a reasonable amount of stuff that looks kind of interesting to me. So it seems like there is a very like wide spread in valuations. Right
Well,
now.
it seems like the gap is less so that value is doing bad. It's more that just the other things are just doing so insane that it's more just that the ceiling is raised. It's not like they're sinking as much.
Yeah.
And because this is so, the amount of money that's flooded the markets, like just throughout the entire world, that's kind of new, just on the scale that we've never really seen this sort of thing happen before on this global scale. A lot of debt, of course, interest rates. It seems like there will be some sort of mean reversion, but it might not even be value going up. It'll be growth going down, or what we consider growth going down. Well, time will tell, of course, but that could be it too.
Yeah, and I'm not sure exactly what time frame that report of Toby's looked at, but he's got a couple of different ETFs. So he's got one where the ticker symbol is ZIG, I think, as in zig when other people zag and all that. And that's, I think, basically been flat since it went public. I'm not sure if someone wants to pull it up, but I don't think that's done that well. And then he also took over another
Deep.
ETF, ticker symbol DEEP, which is more of like a micro cap focus. And I think he took that over in around October last year, and it's done quite well, I think, since then. It may have pulled back the last few weeks, but I think he timed that almost to perfection, which is just pure luck, but that's done pretty well.
And his funds or his ETFs, they also don't follow the acquirers multiple as such in the book. He takes a lot of other, like he has a short side to those books as well. He also looks at forensic accounting type things as well that I don't really understand, but it's not just the strategy that he's back tested over time. A big part of it is the acquirers multiple, but he does have a few other factors as well. Yeah,
I think ZIG is long short, like 120% long, 20% short, or however that maths works. I don't entirely know.
I think you're about right.
And that's sort of a bet on like the the value gap kind of closing as well, like shorting the really frothy stuff with lots of debt and issuing shares, and then being along the stuff that screens well on the acquirers multiple.
Here's Zig, since it was issued in May
Pretty
of
flat.
2019. So
Yeah,
flat
it
overall
hasn't done well.
if you've invested at the open.
Yeah,
It's also a
I
short
mean,
time frame. Yeah.
Yeah, it hasn't been too long, and this is value investing is a long game, and definitely the acquirers multiple is a long game, waiting for that mean reversion.
yeah, and Toby said like he probably released the book looking back at it basically at the top of this strategy working. So it's been pretty terrible timing with that. Are you able to pull up Deep at all? Were you able to track that one down, Jack? I'd be interested to see how that's done. I think the ETF sponsored by something like Roundhill or Roundtree Investments.
I've got it coming up.
Round something.
Issued
So
back
you
in
want
2015.
Yeah, you'll want to look from basically October 2020 is where Toby actually implemented his strategy via this vehicle.
So that was
So it's
where is
up
that?
what
Around here?
50% or something. Yeah.
So around
About
22.
50.
Yeah. So
I
that's
think you
pretty
could have bought
substantial.
you could have bought anything in October 2020 and it would have done well, except Alibaba, of course.
Hey, that's also
Yeah,
true.
what's the index up since October? I don't quite
That's
know.
a good question. Let me
Pull it up, Jack.
Well,
You-
that's
you're
small
like young
cap
Jamie.
value. Which,
pull that up, Jamie. All right, we'll go with SPY since October.
so Deep is essentially small cap value, which over that time period I think performed the best compared to other
Here's
broader approaches.
SPY's
What's
done,
that?
SPY's gone sicko mode.
Probably 3.
What did it start at? So about
About-
25% or so.
Yeah.
What is it? 438 over 3 something. What did it start at?
The live maths by the boys here in the stream.
Started at about
334.
334.
31%.
So
it's done. It's up another 20% on what the index has done. But these are short time frames. Like
Yeah. You're
we'll
gonna
check
find a
back
lot.
in 10 years.
Yeah. For sure. We could say that about everything. I'm down 25%. Check back in 5 years.
And I think on every strategy we've talked about today, they've all performed poorly over the past 5 to 10 years, except maybe Quran's approach. I don't know too much about that.
That was
But we're
probably
all looking at
phenomenal in the last year.
We're all looking at deeper value stuff. So we can assume with the state of the market, that'd be very poor performance. I think this is one of the longest periods of growth outperforming value in the last. It would go back a fairly long way for that to be the case. So definitely a bad timing to be into Magic Formula, acquires multiple, or nets.
It really
Potentially
differs
good
like
time
with
to
each
start.
quantitative. Yeah, with each quantitative exactly. So, time frame really matters. So you got to see where the market is in terms of interest rates, in terms of expectations. Yeah, like even high short interest, if you start right now, you will probably not do really well. Like, it's unlikely you will do well. Yeah.
At least compared to what you had before, with how crazy things happen. Like once the first GME squeeze happened, like every single stock on that list jumped like a lot, and there's still some of that fervor, I'm sure. And it'll take a while for it to wane if it does, like you were kind of saying earlier, Kron.
There was another company also. The ticker is Fizz, so it's National Beverage Corporation.
Mm-hmm.
Like if you look at the graph, huge spike when the short interest happened. But if you hadn't sold, it will come back, exactly where it was earlier.
Oh wow, yeah, I'm looking at it right now.
Pull that up, Jack.
So you could have made like almost 200% within this time frame. Yeah.
Whoa.
It's like a middle finger, like you should have sold.
Yeah.
Let's get some more questions
It's a
going
bit of
here.
trading in there, isn't it?
I feel like there's a hardcore Alibaba ADR discussion going on in the
Yeah,
chat.
there is.
Yeah.
Guys, what do you think about Phil Town buying into Alibaba?
Yes, breaking news. Phil Town
We
made
should-
a video on the dangers of investing in China, and he's bought Alibaba. The filing just came out yesterday.
Well, he's
hot
investing
off
in the
the
Cayman
presses.
Islands, so it's not really the same risk.
Yes, of course.
Yeah.
That makes it so much better.
Yeah.
Alibaba has
Yeah.
all their plants in the Cayman Islands. It's just like it's real assets in there.
Yeah, I'll pull up the exact numbers.
Tom, you'll have a video
just
on
pulling
that
this up on
shortly,
my-
won't you?
Tom's got a video.
Yeah, I'll probably do one tomorrow. I just someone commented on a video, I think yesterday, that there's a new Philtown filing. And I was just like looking through it, updating a spreadsheet today, and kind of it's in a horrific form, like trying to read some of those SEC documents. And
Maybe
it's
you're
like,
reading it wrong.
yeah, you're scrolling for a long time for each holding. And so I was like 2/3 of the way through, then like Alibaba popped onto the screen, and I think my jaw just about like hit the floor when I saw that after the recent video he did. But anyway, the numbers.
Maybe it was like a slight version of Bill Ackman coming on to CNBC saying the hell is coming, and then shortly
Well,
thereafter
I don't know.
buying stocks.
Yeah,
Like
so this
his
is
version of that.
so this
Philtown
is
can really
as of
move Alibaba. Sorry, go ahead, Tom.
all good. This is as of the 30th of June. He owned 30,000 shares in the Alibaba ADR. So this is in his Ruler X Rule 1 fund,
When
which
did his video come
is
out?
like a week ago.
So he invested in it before he made the video.
Sometime between the end of March and the end of June, he bought 30,000 shares of Alibaba, which is on current prices just under a $6 million position in his fund, which is about 4.5% roughly, including cash.
Maybe he sold. Maybe he sold and then made his video.
I don't know,
That seems kind of weird.
Phil's videos do come out a little bit delayed. I've
that could be
noticed sometimes, so I don't know if that's the case for this one.
Seems weird in any event.
Philtown is one to contradict himself with what he does compared to what he says, in my opinion. A lot of things he talks about debt, he often talks very strongly about avoiding debt at all costs, or companies with a lot of debt. But if you look at his portfolio, he's often invested in companies with a lot of debt. That's just one example I can think of. There are other things as well, but
he also leverages his portfolio with options, which isn't true debt, but it's similar sort of risk reward profile.
And I think he's in a weird spot where he is kind of sharing advice to beginner investors, whereas he's a more experienced investor. So I don't think that's too much of a critique on him personally. But the more you look into it, the more you realize what he's doing is not exactly what he's preaching. And that kind of is okay, because what he's preaching still is great for beginner investors anyway. So
yeah, he could dive deep into very technical things and complicated things, but it wouldn't really serve well as a YouTube basics channel.
Yeah, I'm a big Philtown fan. He definitely simplifies stuff for most of the content he puts out, but there's a lot of overlap in his portfolios with like a lot of hardcore value investors,
And I mean, that's what Buffett does too. He very much simplifies things, and then he's going deep into like complicated bank stocks with crazy balance sheets that you have to dive through, and insurance companies, and those aren't very easy to like really get into. But he talks about investing like, it's very simple. You do this and this and this, but like it takes some serious due diligence. And he does warn about that too. So just kind of part of the game. It's a lot harder to communicate complicated topics in an interesting way.
Yeah.
Guys, do you think we'll see Alibaba in the Berkshire 13F? Will it show up? No?
I don't think so. I'd like to.
I don't think it's impossible, but I can't see Buffett. Maybe Ted or Todd. I can't see Buffett, making it like a Apple size position or anything.
In my mind, though, I did put a tweet out about this a month or so ago, saying it probably is one of Buffett's best options right now to make a sizable bet. He only has about really 50 investable companies in the world. If he wants to make a reasonable size allocation, say 10% of the portfolio more. And Alibaba certainly seems to be one of the higher quality, cheaper companies on that list. So in my mind, it would make sense. I think he would probably avoid it just being China in general. I know Charlie's a lot more bullish, so maybe he gets persuaded there. But in my mind, it would be a good decision for him, but I can't see Buffett actually doing it.
But BYD is
Yeah.
also a Chinese company.
True.
So
That's true.
Yeah, that's what I was just about to say. That's the one that Charlie
Yeah.
did convince him on. But it was
What-
small. It's grown a lot. It was small.
What's the allocation on that now in the portfolio? Does anyone know? The percentage?
Hey, Jack, can you pull it up?
Yeah. Wait, who was it again?
BYD. Berkshire Hathaway. BYD. I mean, it was big enough to make their top holdings in their annual report, which is only the top 5 or 10. But
Yeah, okay.
it's gone up so much that it kind of just launched its way there last year. And it's come down a little bit, but still up a lot in the last couple of years.
But I certainly hope he invests in Baba. It'd be good for the share price anyway.
I'm often surprised at how much Buffett doesn't move stock prices on larger companies. Like he actually got a lot of hate for not hate, but there was a lot of skeptics when he first bought Apple, for example, which kind of gets forgotten at the moment. But everyone was like, this guy doesn't know what he's doing with tech. Just look at his IBM investment a couple years before the Apple stake. And he's proved them very wrong. So
Certainly has.
Yeah.
There's a good debate going on about Alibaba, and it's still going.
Yeah.
I think that,
So Alibaba has their ADR in the Caymans, which is like it theoretically gives you the right to some slice of ownership of the actual company. That's how they got around China's very strict listing restrictions against listing in the US. They listed in the Caymans, which then could list in the US. It was a workaround. So there's definitely some risk there in what would happen from a regulatory standpoint, as well as what would happen if, say, the US restricted Chinese listings in some way. Would that affect the ADR as well? But it's a very complicated workaround. Or I guess it's simple. It's just complicated if you look at the actual legal structure.
yeah,
but I
it's
think
been an
it's
ongoing
impact
debate
shows
for
them.
years.
What was that, Tom?
It's been an ongoing debate for years, but it's become a hot topic again in the last week, I suppose.
Yeah, it has been. And what'd you say, Karan?
Yeah, and that's pretty much why we're getting Alibaba at the price that we're getting it at.
Yeah,
it's the uncertainty.
It's macro
fear,
fears
the doubt.
for sure. It's definitely macro fears.
There's no way it would be trading at the valuation that it's trading at if it was a US company or any other European company, whatever.
I think a big part of an investment in Baba is you have to consider the risks, the macro risk to it. I guess the CCP is a huge risk with some kind of regulation or something in the future. But in my mind, there's a lot more upside. Even if you're just looking at the overall Chinese market, they make up about 20% of the world's GDP. They're growing that GDP at about 7%. It's moving from an emerging to a developed market. So even if you're looking on macro perspectives, there's just as many pros as there are cons in my mind. And a big part of that, I think we need to ignore anyway and just look at the actual business. And it seems like a great business and it seems very cheap. So I think it's worth some allocation, whether how big that allocation you want to take on with the risk of the CCP is important. But in my mind, I think 10 to 20% is reasonable to have in China.
I think that's where if you're nervous about something like that, about regulatory risks and whatever with China, that's where concentrating could be pretty much more risky than it might be in another spot if you're worried about that. To where something maybe like some sort of ETF, if you want a basket of Chinese companies, if you think that the broader market is relatively undervalued, that could be something you consider. Dare I suggest investing in an ETF or like index fund type thing. But I mean, a lot of the emerging market funds are super heavily China weighted. That's how I have like my 401k at work, which is like our like tax advantage retirement plan. You can only invest in certain index funds. I have like half of it towards non-US and emerging, which ends up being quite a bit of China because it is such a huge, it's a huge economy with a lot of huge companies. And so I have I have exposure there, even if I don't concentrate into any one particular company like Alibaba or whatever outside of it. So that's another thing to consider if you have like any diversified investments anywhere in something like a work sponsored retirement account or a government sponsored one, where it's often index funds are the only choice anyways. So it's just food for thought.
Entertainment purposes only, of course.
yeah. I'm not saying
I-
that now you're perfectly exposed to all Chinese companies.
Yeah.
It's more complicated than that. But take a look at what some of those funds have, because often they're pretty heavily weighted towards a particular country or even a few companies.
Yeah, I'm going to be really interested to look at Li Lu's 13F when that comes out, or maybe the next couple of 13Fs, because I know he sold Alibaba last year, I think. Bought Pinduoduo, and I think that's down a fair bit. So I'll be interested to see if he makes any moves, and some of the at least US listed like Chinese companies that we can see in a 13F.
Let's get maybe one or two more questions and wrap it up. This is very much an argument, a peaceful discourse
Such a hot topic at the moment.
within the chat right now. It's actually kind of hard to find questions.
It's all Alibaba, yeah.
Yeah, it's like the two sides of the Baba argument. It's good stuff.
We had one
the
on
last time I
Greenblatt
saw-
special situations a little bit there.
The last time I saw so many like value investors getting into a stock was Micron. I think that was the large company, right? Oh,
Seritage
Apple
is a
before that,
handful, but
probably.
not nearly as many as what Baba has now.
Yeah.
Maybe Apple.
Yeah, I think Barber's
before
kind
that.
of taken over the value community. Anything Monish buys kind of takes over the niche value YouTube community that we're in, I guess. But
Yeah,
this
I
one's
wonder
gone
how
a bit
much of
beyond
it
that
is tunnel
with
vision.
Charlie Munger. Yeah.
How
But with
much of it
Charlie
is
Munger in
tunnel
on this
vision?
one, it extends it to the larger audience as
Right.
well. So it's definitely a very popular stock, and I'm assuming all our views on our YouTube videos can back that up for us.
Yeah,
Do you guys think? Do you guys think we could get Monish and Charlie on the live streams?
that'd be fantastic.
No, Charlie
Doesn't-
likes
didn't
Zoom,
Charlie-
right?
I feel like
Yeah.
Monish could potentially be game if we get large enough. I think he'd be interested. 'Cause he goes and
Yeah,
speaks
well-
he goes to schools and stuff and speaks for them and they record it. So like we could just tell him we're at a school of value investing or something.
Yeah,
Then he'll come.
Charlie said he uses Zoom 5 times a day or something.
Yeah,
didn't he?
he's sharp with it. Like he's got the tech stuff. He knows
We'd,
the
we'd have to
internets.
move to Zoom. We'd have to move to Zoom for an episode rather than StreamYard to get him on.
Screen record Zoom. That'd be pretty legendary. Anyone have a question that they want to answer? Because I've been kind of scrolling up and down, while trying to talk at the same time, and it's not very effective.
There was some a long time ago, but the Alibaba talk really took over that.
How about?
Yeah.
A lot of questions about China, but I think we've kind of covered
Yeah,
that.
we were kind of
fair
talking about. Yeah, there were a lot of good questions about China, but I think we covered them kind of on how to.
What about
recognize risk.
maybe we touch on? I see that I can't find it, but there was something about Greenblatt special situations. Shall we maybe talk a little bit about like Joel Greenblatt's
There we are.
enormous change in strategy? Because it was a pretty wild switch from I think he was in like a handful of stocks typically, maybe slightly more than that, but very concentrated to being very diversified now. And I think he even does some long short stuff with Gotham, but very, very quantitative now. Do you guys have thoughts on that?
Well, one resource I'll throw out there that I'm surprised I only came across recently is the old Greenblatt lectures back from early 2000s. Off the top of my head, I can't remember which university or anything he was working at, but it's pretty much a series of lectures where you can just get, if you type it into Google, you'll find it pretty quick, just the transcript for it. And it's really that special situation approach, similar to what I guess he made the book. What's it called? How to Be a Stock Market Genius. Is that the one?
You can be a stock market genius too.
Yeah. So it's kind of a broader look at that, or maybe the earlier insights for that book, which is a great resource to have a look at if you're interested. I guess Greenblatt's really come across a lot of interesting strategies, of course, being Magic Formula, the specialist situations, and now he runs a very diversified, pretty much broader market index type approach.
Yeah, it's like a modified S&P 500 or something like that, right?
Yeah, a long short approach to that as well, I think.
Yeah.
Which he says backdated can match Magic Formula returns, which I find hard to believe. I would like to see how well his new ETF performs. But yeah, I don't know. It's interesting. I certainly like the special situation stuff that Greenblatt talks about the most, compared to Magic Formula or what he's doing now as well.
Yeah, I'm reading Richer Wiser Happier at the moment, and there's a chapter on Joel Greenblatt, which is very interesting and kind of goes into this. And Joel Greenblatt, I think, did over 40% a year for like 20 years in his special situations fund. It was just ridiculous returns. But there are a couple of things that he did. Like he was very concentrated. He intentionally always stayed small. So there were really no investors that were in that fund for the full length of time, because Joel Greenblatt was constantly giving them their money back to try and stay small enough to invest in some of this stuff. And he also said that like once every 2 or 3 years, they'd lose 20% of their net worth in a day because one of these things had go south. And he's perfectly fine stomaching that, but some of his investors perhaps weren't, I think. So now he's maybe moved to, he's at the point where he's rich beyond his wildest dreams and just wants to kind of chill out a bit, I think, and also have a strategy that other people can get involved with that can sort of scale up. Like he's not restricted to the really small stuff.
Yeah, I think he's trying to smooth out that volatility so he can, which once you get to a certain amount of capital, I think most investors just have to do that. They have to move away from the smaller, more illiquid securities, remove some of that volatility so they can just probably more slowly compound a large amount of wealth, which is pretty much what every investor you can think of has kind of done once they've reached a very large sum of money.
Yeah. Plus, it's just way easier to manage that way, anyways. Just buying a basket of high quality big companies is like, all right, buying a nice company today, even if it's not particularly cheap.
And then he has to say it works as well as special situations, just for marketing purposes.
Exactly. You got to keep that asset under management, of course. Then you're good.
Yeah.
All right, this is a good one to wrap up on. You either die a trader or live long enough to see yourself become the market. That's fantastic. I love it. Well, with that, guys, final thoughts? Can we wrap it up? Almost an hour 20 for this one. Nice long stream. We started a little bit later than normal.
Are there any names that you guys are excited for today? Or is that something we'll keep for the best ideas episode?
Any names, like stock names, like this one?
I think so, yeah.
Or like investor names? Probably stock
names, baby names. I don't know. What are you talking?
I need to, like, now that I've closed on my real estate deal, time to look at a real estate company that Brad brought up last time with FRP Holdings. I'm very interested in that one. I'm having trouble finding some like well articulated like portfolio breakdown documents, so I can quickly take a look at like what's the address of every property they own, for example. That's that I want to get into for sure because it looks enticing. So that would be my idea. That's really Brad's idea.
Yeah, I'm just going to pull up Phil Town's thing again. So there's one other company that's new in Phil Town's portfolio, which I might take a quick look at. It doesn't jump off the page. It's something super interesting, which is Sprouts Farmers Markets. He had, I think he'd sold puts on it in a previous update, so may have been forced to buy. I'm not sure, but that's another recent addition. So might take a look at that. But yeah, I'm really spending most of my time just continuing to understand. Well, not just Alibaba, but a lot of the Chinese listed companies. So
you're house shopping too.
Yeah, also house shopping. That's why I was out last week, off looking at open homes and stuff. So that's taken up a fair bit of brain power as well. What's that thing Bill Ackman says about return on brain damage rather than return on investment. That's
I haven't heard that.
that's what he talks about. I think, with leaving these small little positions in your portfolio that really aren't going to move the needle, but take up a lot of your thinking. I feel like that's what the house hunting is not going to be a small percentage of my portfolio, but it takes up a lot of time.
Exactly.
Yeah.
The one name I'm looking at, just to throw it out there, I'm looking at Hingham's Institute of Savings, which is a regional bank in the US. Mostly that's just sending me down a rabbit hole of trying to understand banking in general, which I really have never done. So it's
go for
particularly
it.
particularly once you move into the regional stuff at these smaller banks, they are certainly a lot more easy to understand than the larger banks. And it's a super interesting company, and there's some other interesting names I'm coming across around the same size. So that's been a good rabbit hole to go down to kind of try and understand that banking sector anyway.
That's been a bit home run the last couple of decades, right?
Yeah, it's already been a 100-bagger over the past however many years, but it's still only a $600 million company. So still very small, and some great capital allocators there, and they've really been able to manage their loans very well. They got through the 2008 downfall with barely any failed loans. So, some great numbers put out by the company for a very long time. Even in their annual reports, they'll show 25 years or so of their historical financials, which is very rare to see in any annual report. So they're bragging about what they've done.
Do you know what insider ownership looks like? Because oftentimes, once the regional banks are doing well enough, it just gets scooped up by one of the huge ones.
It's fairly so there's some family history to it, but the son, I think, of the person that's taken over here, spent about 10 to 20% or so. He's the largest. The CEO at the moment is the largest shareholder. I'm not sure of the overall insider ownership. Super interesting name, worth reading through their annual reports and shareholder letters just to learn a lot about the industry either way. Whether or not you think the stock's cheap or worth buying is a different story, but a great management team and some great information to look at.
All right, good one. Karan, anything?
Yeah, so the company that I'm right now looking into is called IWG, and it's in the same space as WeWork, so in the flexible office space, and they're actually the largest provider of flexible office space. And it's an interesting company to look into, and what they're doing right now is they're switching over to more of a capital light model, and they're selling off the master franchise agreements for across the world, and they're raising short-term cash, and they're going to be using that and converting the entire model into something like Hilton. So basically outsourcing their brand and earning royalties off of that. So it's like the business is fundamentally changing. It's interesting.
Yeah, that's like a high uncertainty sort of space.
What was the ticker on that one, Karan?
IWG.
IWG. Sounds very growthy. Is it cheap, or how are you seeing that one at the moment?
If the short-term deals with the master franchise agreement work out, it's basically they get a lot of cash upfront, and then they can use that cash kind of maybe return it to shareholders, because that's what the CEO has kind of said, that we're planning on returning this huge chunk of cash that we're going to get in the short term, and then they'll just basically get royalties over the long term. So it's consistent dividend paying sort of company.
I have to
It's
check it
listed
out.
in London. Is that correct?
Yeah. So they've been around for 30 years now. So it started with one flexible office space, and it's grown to 3,300. And their plan is to grow to around 30,000 in the next 10 years or so. And this is completely through agreements. Yeah.
All right.
Well, there's some homework for the people watching.
That's for legitimate ideas. So go for it. Go forth and conquer, or don't do anything with them, because there's lots of ideas out there. They just take a while to find, depending on how particular you are about what you're trying to invest in. Anyways, this has been great as always, gentlemen. I will see you guys next week. And we hope to see all of you guys next week. And to make sure you don't miss the next episode, be sure to subscribe. And before you hit that subscribe button, gently tap the like button to make it turn blue, because that would help the channel out too. And check out our Discord in the description below. And be sure to sign up for that if you haven't already. I think we're at about 200 members now. It's growing slowly, but surely, and there's some good stuff in there. But otherwise, we'll see everyone next week.